Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, which is the value investor's best friend. A lot of you have been asking me to get some more in-depth research on value stocks that look very attractive today. And today I'm going to cover a dividend champion, a company that's increased its dividend for 53 consecutive years, and it's considered a major leader in its industry. But the stock has recently taken a deep hit, and which is why I become interested, which what makes it look very attractive. There's also some forthcoming news that you want to know about that really might make this an opportunity that you shouldn't pass up. But as always, I do, even after I go through what I'm going to show you, do your own research and due diligence. Anyway, let's go look at the medical diagnostics company, Becton Dickinson. Now, there's some interesting things that I want you to see immediately, and this is one of the beauties of FastGraphs. And if you aren't subscribing to FastGraphs, you should be, especially if you own stocks. Now, what we see here is that the market, on the blue line on this graph, which is the normal PE ratio, the market has put consistently about a 19 to 20. It's actually calculated at 19.01. If I drop it to 15 years, it's 19.81. The point is, it's a very highly valued stock most of the time. Okay, that's because it's extremely high quality. It's got less than 40% debt, and it is a global leader in medical technology. It has a diversified business and strong innovative pipeline, according to analysts. But again, this is a dividend champion. It's actually a dividend king in that it's increased its dividend every year for 53 consecutive years. All right, so you can see on the line, we only go back here on FastGraphs to fiscal year 2005. By the way, it has a September fiscal year. And you can see by the gold line here, the dividend has gone up every single year. And the average growth rate of the dividend has been about 5 or 6%. And we can take a look at the performance chart real quick and see over the last 20 years, the average dividend growth has actually averaged over 9%, okay, which is excellent. So if you've invested $10,000 in the stock back in fiscal year 2025, on September 30th, 2024, actually, you would have started out with a 1.39% yield at that time. And that yield, your yield on cost, would have increased to where last year you got over 8% dividend. But I call that growth yield. Now, the beauty of that is because the stock is so inexpensive today, because as you can see, the price has dropped precipitously this year, even though earnings growth has continued on an operating basis to do well. Okay, and there's some headwinds that we'll be talking about, some issues with stuff going on in China and other issues that you could research and do, for yourself. But what I want to point out is you can buy this stock now at a blended PE ratio of 12.6 on adjusted operating earnings. Now, FastGraphs looks at operating earnings, basic earnings, and diluted. Most financial sites will report diluted earnings. On a net basis, the PE looks like it's 34. Okay, that's because diluted earnings continues a lot of one-time charges and non-operational stuff that dilutes it. Most analysts prefer valuing a business based on adjusted operating earnings because this gives a clear picture of how the business is actually performing as an operating business. Now, the things that are striking here, this was the recession of 08 and 09, and we can see that coming into the recession, the market was routinely pricing it at 19 times earnings or higher. Remember, the blue line is 19 times earnings, we'll call it that, on this graph, on this time frame. But then when the recession came, we had a period of time where we could have bought the stock at lower value, like here's 13 times earnings. It's currently 12.6. We did get periods of time here during this aftermath of the recession where you could have bought it at a very attractive valuation. And had you bought it at one of these attractive valuations, up until it fell here recently this year, and I hit the perfect top, you'd have averaged over 10% a year with a company that's offering you the growth of dividend income. So this is a capital appreciation as well as a total return vehicle. All right, but the key is that the stock has fallen precipitously, and you can see it's been marking time recently, more recently after it had the big drop. And again, that was because of some issues with China and some other issues on what the company's been going through in terms of their operations and their different divisions. But here's the thing that I think is very intriguing about this company. Their business development plan is that they are going to separate their businesses. And there are many analysts, including yours truly, that believes when they do, that's going to unlock a lot of value, especially when you can buy the stock at such a low valuation today. Now, this is going to happen and probably won't be finalized till sometime in 2026, but most of it's going to occur and be announced in 2025. And that could be a catalyst to see an increase in the value of the stock. Right now, the stock offers a 2.36% dividend yield, which is excessively high for this company. Normally, their dividend yield is much lower when the valuations were high. When the valuations were very low coming out of the recession, you had periods of time where you could buy the stock where you had dividend yields. Here's 1.89%. Here's the peak yield when the stock was really trading at a low valuation, I want to point out. The peak was 2.29%. Well, we're at 2.36% right now. And so this would be the highest dividend yield entry that you could have gone into for the last 20 years. That's another very strong indication of value. Now, again, diluted earnings, which includes a lot of non-recurring, one-time, and non-cash items, would show the stock having a much higher valuation. But again, you really, in my opinion, and most analysts' opinion, you really want to look at operating earnings. Okay, now with fast graphs, you can also look at this stock on several other different metrics. For example, let's look at operating cash flow. Now, one thing I really like, I don't even necessarily want to, well, it's very cheap on an operating cash flow basis. Its price to operating cash flow right now is 13.25. Its normal price to operating cash flow has been about 15. But if I do this for the last, say, 7 or 8 years, that normal operating price to operating cash flow has been over 21. And again, by analyzing the stock, going through these different time frames, really helps you understand what's been going on with the business. But here's what's important. I don't even care too much about price here. I want to see the operating cash flow significantly higher than the dividend, which is the gold line. In other words, in 2019, they had $11.82 of operating cash flow covering a $3 dividend. That's what you want to see. But I also point out that the acid test is when the free cash flow, which is the money left over after the company has spent all the expenses to run the business, is still covering the dividend in every single year. So this really is a dividend champion, and I guess you could call it a dividend king. All right, and the point I want to emphasize very strongly here is you don't get a chance to buy the stock this cheap. In fact, this might be one of the cheapest I've ever seen the stock in all the years I followed it. I followed it for many years. I've never owned it. I would have, could have, should have bought it during this period of time, but I had almost every name you could think of was available here. But coming in, starting in 2013, like I've showed you with so many other names, we start getting these real high valuations. And notice how when the valuations got high here, notwithstanding the peaks and valleys, the stock really marked time for all these years. There was a lot of volatility, but the stock really went nowhere, and you can visually see that with a fast graph. That's what's so beautiful. Now, from a standpoint of today's opportunity, if I look at the price today, and if it going back to a more reasonable 15 PE ratio, which is the orange line, then that would give me an opportunity to make over 16.5% a year for the next couple of years. Ceteris paribus, all things remaining equal. But keep in mind, they're not remaining equal. This company is going to split up and separate their divisions, which again could unlock a tremendous amount of value for shareholders or investors who are willing to invest in the stock when you can buy it at these levels. Now, if the stock went back up to its normal 20-ish, 19 in this case, PE multiple, we're looking at an opportunity to generate almost 30% annualized rate of returns, plus be paid a very nice dividend along the way, and this could be a buy and hold stock for the long run. Looking at forecasting going forward, analysts expect about 6% growth going forward. That's very doable. The company's guidance is pretty much corroborating that. But again, that gives us this ability to make these really terrific returns, assuming the company's price reverts back to the mean. Now, this would be a 20 multiple where you could be actually making over 30%. That's been the 5-year normal PE ratio for the company. All right, now if I go into fiscal fitness real quick, just go through some benchmarks here that I like to look at. I've already showed you the free cash flow has been higher than the dividend. operating cash flow growth, this is for the last 3 to 5 years, has been about 19% a year. Share buybacks, the company has been buying back or issuing stock during the period of high valuations, which I liked. Operating cash flow has been higher than net income. Sales revenue has continued to grow in spite of some of the headwinds I've referenced already. Their debt to equity is very interesting because they've actually been reducing debt lately. Now, I could go into fund graphs, by the way, and go into the company's financial leverage ratios, and you can see that their long-term debt to equity has actually been getting lower. They've actually been paying off some debt. But now, again, the company is getting ready to go through this big divestiture. But looking at the company from a standpoint of margins, the company's margins are holding up. They look very excellent from gross operating and net margins. The company's return on assets and equity have basically been holding up for the last 3 years. Returns on equity have been holding up, and returns on invested capital have been pretty much holding up. So I really like this company as a value play today, an extremely high-quality value play, a dividend aristocrat champion, and actually a dividend king now because they've, again, grown their dividend every single year for over 30 years. Now, where the stock's going to get interesting is when they really announce these business development plans they have and what they're going to do, how they're going to spin it off, what they're going to do in terms of shareholders. And we really don't see that too much right now. Now, their Becton Dickinson Medical represents about 48% of their business. Life science is about 24% of their business. And their last segment is about 27% of their business. So the company is going to be separating that and unlocking value, which could, again, be a tremendous boost for people going forward who are willing to invest in the stock right now when the news is actually as bad as it is right now, or at least it appears to be bad. I don't think the news is really that bad. Analysts are still very pro on the company. I don't know of any sell for leading Wall Street analysts that have a sell. The most of them have a buy or a hold here. So this is a very interesting company that you might want to look a little deeper into. As I pointed out, the metrics, the fundamentals of this company have been consistently good. And you can see when overvaluation rears its ugly head, it's a bad time to invest. But when you can buy the stock at low valuations like you can today, even at today's low valuation, it's still an excellent long-term investment. But imagine what happens if the market goes back to valuing at a very high valuation. So anyway, this is Becton Dickinson. It's a dividend aristocrat and champion and king, as I've mentioned. I think it's an excellent buy today at adjusted operating earnings valuation of 12.6. That gives it an earnings yield of almost 8% and a dividend yield of 2.36%. And remember, this company doesn't pay out a lot of its earnings because it still is in a growth trajectory. And that's another positive, I think, for the company. Anyway, I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to our channel if you don't already, and take a look at fast graphs. It's definitely the value investor's best friend. You can see very clearly that value exists for this company as long as these fundamentals hold up. Now, of course, that's going to change because now we're going to have this divestiture, but you're going to end up getting, as a shareholder, you're going to participate in that, and it really could, as many analysts believe, unlock a lot of value. Hope you enjoyed it. If you did, ring the bell, as I said. Like the video. I'd appreciate you doing that. And as always, thanks for watching, and we'll see you on the next video. We're going to start doing more and more deep dives, and Fast Graphs has some extremely renovating and exciting news coming out soon that's really going to help value investors. So when I say it's the value investor's best friend, I think you're going to soon discover that's a great understatement. Thanks for watching.